Hey, what's going on everyone? It's Griffin here, and a couple of weeks ago I released a video speaking about some great long-term buy and hold ETFs to pick up during a recession or quite simply a bear market as we're experiencing right now when price points are severely depleted. That video got some pretty good engagement and feedback, so in today's video we're going to be digging into this even deeper, speaking about some great long-term dividend-focused exchange-traded funds for that portfolio income in a period where asset appreciation pretty much market-wide is quite scarce. So what we're looking for specifically today are dividend-focused ETFs that follow a relatively strict set of criteria, which are as follows. So first and foremost, higher stability in overall returns over time. Second, a dividend yield that's above market, but not necessarily anything unrealistic, and that wouldn't be sustainable over time. And then finally, a lower management expense ratio, anything below 0.5%. Hey, and by the way, if you're new to investing, make sure to check out all of the links down below in my description to get 3 free stocks with Wealthsimple Trade if you're Canadian, up to 10 free stocks with Moomoo for a limited time if you're in the United States, and full access to my entire stock market investing course over on Skillshare entirely for free on a 1-month trial if you're looking to bring your investing to the next level. So with that said, let's talk dividend ETF, starting with a staple in the American market being the Vanguard Dividend Appreciation ETF, ticker symbol VIG, and this fund trades on the New York Stock Exchange. Now, VIG is a solid option for long-term dividend investors for a couple of reasons. First and foremost, it has a passive approach to tracking the S&P US Dividend Growers Index, and it also has a rock bottom management expense ratio at only 0.06%. This means that when investing $1,000 into this fund, which is a realistic amount for pretty much anyone watching this video right now, well, you would only be paying 60 cents in management fees over the course of an entire year. You can't really get much lower than that. In regards to VIG's composition, well, this is one of the main reasons why this fund is considered to be a dividend appreciation play, which offers the possibility to get some income while also some growth over time, meaning it has a slightly higher tolerance for risk as opposed to some of the other funds that we'll be looking at shortly that are a bit more conservative. Right now, the fund has 289 positions held within it, most of which are large cap blended positions, meaning a mix of both value as well as growth, which is pretty much the entire goal of VIG in the first place. The stocks in question held within VIG are very much spread out across multiple different industries. Taking a look here, we can see specifically information technology, healthcare, financials, as well as consumer staples to really give this fund a well-rounded exposure to the entire American stock market with a dividend angle. As a result of this higher exposure to the IT sector though, well, as with the rest of the entire S&P 500 that's also heavily weighted towards information technology, VIG sees some depreciation over the past 6 months as well, down roughly 15% from all-time highs, and this is in comparison though to the S&P 500, which is down roughly 20%. Over the past 10 years though, average annual returns of 10.97%, which is fantastic for such a passive fund. And I've said this before, but with a broad market, a solid fund like this one, seeing values depreciate in the short term really just should not be a cause for panic if you are investing with a long enough time horizon ahead of you and you're not looking to trade in the short term or swing trade any of these positions. At the end of the day, you wouldn't be swing trading VIG in the first place, but VIG isn't going to be a cash cow of a dividend ETF for you, but it still offers investors a nice 1.93% dividend yield, which happens to be the lowest of the yields that we'll be seeing in today's video, but this is also due to the secondary angle on growth with this fund specifically. Hey, and by the way, another interesting option for a dividend growth ETF, if that's something that you're after, would be the Wisdom Tree US Quality Dividend Growth Fund, ticker symbol DGRW. It has a slightly higher management expense ratio at 0.28%. However, the higher distribution yield, dividend yield, does make up for this higher MER, and it's also a fund that focuses on that dividend growth angle. Moving on to the second dividend focused exchange traded fund, this one pretty much drops the growth angle to it and really focuses on that dividend income, right? And this is the Vanguard High Dividend Yield ETF, ticker symbol VYM. VYM is also a solid long-term dividend play with its rock bottom management expense ratio as well at 0.06%, and it also passively tracks the FTSE High Dividend Yield Index, which includes common stocks that have a focus on a higher dividend distribution without, say, including positions that have, say, a 17% dividend yield trap. As a result, well, in contrast to VIG that also had a blend of more growth-oriented positions, well, with VYM, we're looking at mainly large cap value stocks, and currently, in fact, there are 443 positions held within this fund, and due to the exposure towards equities exclusively though, well, we're still looking at a 4 out of 5 star in terms of risk tolerance. Now, although this fund has nearly double the amount of positions funds, well, its larger focus towards dividends specifically give it a completely different sector allocation breakdown, with the largest sectors being healthcare, financials, energy, as well as consumer staples, all of which makes sense considering the fact that this is a dividend-focused exchange rate fund, and each one of those industries typically have companies with higher dividend yields. Overall, you can't really go wrong with VYM if you're looking for a dividend-focused ETF that has a pretty decent yield as well as rock bottom management expense ratio. VYM currently has a higher dividend yield at 3.04%, and returns over time are typically more stable as a result of the stock composition. So year to date, VYM is down only 10%, which, as we can remember from earlier, is actually quite a bit less than the broad market S&P 500. Moving on to an even less volatile dividend-focused ETF, we've got a fund that only holds 50 individual stocks, each with lower volatility and a higher yield as specific criteria to make the cut. The ETF in question is the Invesco S&P 500 High Dividend Low Volatility ETF, ticker symbol SPHD. And what makes this one special is its very high dividend yield at 3.92%, which is quite high for any ETF, specifically a dividend ETF that doesn't utilize any other types of financial maneuvers in order to raise the dividend yield like some other, say, leveraged ETFs or covered call ETFs that'll have yield above, say, 5%, right? This is really an equity-focused ETF that only holds companies that have higher than average dividend yields, right? And at 3.92% dividend yield, this means roughly $40 worth of income yearly on a $1,000 investment, and that's after the 0.3% MER. Okay, so a slightly higher management expense ratio, but this is in parallel to a much higher dividend yield and also much more stability in the returns over time. What do I mean by lower volatility though? Well, unlike with the two previous ETFs we just looked over that have been hit pretty hard by recent market tremors, well, due to the more conservative approach of the 50 positions held within SPHD, we can see that this fund's returns year to date have actually been quite flat. And when zooming out to a longer timeline, the fund's movements aren't as radical. So during a period of higher volatility and uncertainty as what we're experiencing right now, well, this type of lower volatility fund can definitely make sense for investors who have a much lower tolerance towards risk, which really should not be underplayed. In fact, this fund would have what I'd consider to be a 3 out of 5 risk level if invested in over a more than 3-year period. Now, in contrast to the S&P 500 as a baseline here, SPHD tends to actually underweigh information technology, consumer discretionary financials, as well as industrials, and overweighs the utilities, consumer staples, real estate, as well as energy and material sectors as the main areas of focus for companies held within this fund. This results in a performance that over a long enough period of time actually tends to underperform other options like VIG or even just quite simply the S&P 500 index, as we can see from this chart right here, even though this doesn't take into account recent market returns since, say, 2022. So overall, SPHD might satisfy higher income seeking investors, but if you're an investor who doesn't necessarily care about risk as much and you're looking for more of growth in parallel to dividend income, well, you might be better off with another option like VIG or DGRW. Hey, I really hope you're enjoying the video so far. I wanted to take a quick break here midway through to speak about not a video sponsor, but actually just some of the different links and offers that I have down below in my description. It's pretty much no secret that, entering into pretty much a recession here at this point, a lot of sponsors have been pretty much cutting their advertising budgets across YouTube, and also overall interest and views towards finance YouTube have been down pretty much platform wide. So as a creator here, continuing to make videos like this every single week, 2 to 3 times, it would really help the channel out if you could check out some of the links down below to affiliate links where it's really a win-win. You can get some free stocks, some free money for signing up to some of those offers, and I get a small kickback in return. And also, if you're interested in some of the other programs I have a full stock market investing course. That one's entirely free, and also a newly released real estate investing course that I released about a month back at this point, and it took like 6 months to make. It goes over everything from knowing nothing about real estate to securing your first deal. So if any of that is of interest to you, make sure to check out those links down below in the description. And also, most of my videos at this point get 2, 3, 4,000 views, but very little engagement and comments. So everyone watching this, make sure to comment down below, drop a like, like, let me know that you're here. It really makes it a lot more engaging and fun as a creator to continue making these videos. With that said, let's get back to the video. All right, moving into the next dividend focused exchange traded fund here. This is also one offered by Invesco, and the goal of this ETF is to start with the S&P 900 index, but then it actually has a pretty specific set of criteria to select the companies in question. So first and foremost, it excludes the top 5% of securities by dividend yield. Second criteria, it excludes the top 5% of securities within each sector by dividend payout ratio. 3, selects the top 60 securities by dividend yield. And then 4, it reweighs those securities according to the revenue earned by the companies in question. And no company can have a weighting of more than 5% in this entire fund. This ETF I'm referring to is the Invesco S&P Ultra Dividend Revenue ETF, ticker symbol RDIV. Now, the criteria that this fund follows seems to be extremely complicated, so you would think that the management expense ratio would be crazy high, but as of right now, it sits at 0.39%, which honestly isn't necessarily too bad considering the dividend yield at 3.6%. And in addition to this higher than average dividend yield, actual fund performance has been holding up quite nicely, even in this current market environment, with year-to-date returns that are basically flat but stable and consistent movements when we zoom out over a longer time frame. This is due to the fund's internal composition, which is made up of 62 holdings ranging from anywhere from large all the way to mid-cap value, but then also blended positions. And these are mainly concentrated in healthcare, utilities, financials, as well as consumer staples as the main industries of focus. In fact, when looking at average annual returns since inception of this fund, we're looking at just under 11%, and this is in contrast to the S&P 900's 11.64%. And again, this is very typical of equity only versus dividend plays. Lower volatility in the short term, but then also lower overall returns over the long term, right? Because when we look at returns on investment, we're taking into account both the appreciation, so the fluctuation in market value, but then also any dividend income added to that value. So typically speaking, over a longer period of time, equity only plays tend to outperform dividend plays as well, even though they're not generating any portfolio income. So ultimately though, this really just comes down to what you are personally after as an investor. Hey, so by the way, if you're interested in learning more about how you can actually go about identifying and picking quality dividend exchange traded funds yourself, then I would highly recommend that you check out this video right here that I made a couple of months back, going over everything you need to know about properly dividend investing. So learning all the terminology and then sifting through various different dividend ETFs and even specific dividend stocks to find the best ones suited for your needs as an investor. Definitely check that video out right now if you haven't already. And also, again, check out all of the links down below in the description if you want to, learn more about stock market investing and also get some free stocks to start investing yourself. With that said, thanks a lot for watching today's video. You know what to do. Subscribe, hit the bell button if you want to learn more about upcoming videos that I'll be releasing on the channel. And if you enjoyed the video, please take a second, drop a like. It really helps my channel out. So with that said, I hope you all have a fantastic day and I'll see you in the next one.